Welcome to the latest Motley Fool Scoreboard. I'm on in Chocobaloo. We've got longtime fools Nick Sciple and Tyler Crowe giving a 1 to 10 rating to oil major Chevron, ticker symbol CVX. First, we'll talk about the strength of Chevron's business, including factors like industry and competition, and there's a lot of competition. A 10 is invincible, a 1 is hopeless. Tyler, both of you have 7s.
Yeah, I mean, Chevron, I think we've all seen the gas stations before. This is a, integrated oil and gas giant with assets in exploration, production, refining, pipelines, chemical manufacturing. It pretty much touches every part of the value chain of oil and gas. Historically, integrated businesses have done incredibly well for investors over the very long term, despite the ups and downs of the cycles of oil and gas, in large part because their diversified assets tend to offset each other. The one thing that you can say about Chevron in particular in this industry relative to the other like integrated majors is that this one is actually a little bit more weighted towards the exploration and production side of its business relative to the other ones. But I would still say that it's like downstream assets are sufficient enough to, provide that counterbalance to the swings in commodity prices, that it's not like an absolute game changer in the thesis for this business.
Yeah, don't have a lot to add to it. What Tyler said there, this is one of the big integrated oil and gas companies. This is one of the descendants of the Standard Oil monopoly that really started the oil and gas business. Because it's integrated, because it's international, this is one of those energy companies that's better situated to weather the oil and gas cycle than many others in the industry. But just like everybody else, it's exposed to a commodity market where results are going to fluctuate based on variables that are totally out of management's control. That's why it's just a 7.
All right, let's move on to management. 10 is Warren Buffett, a 1 is Homer Simpson. These scores are lower. Nick's got a 6. Tyler, you've just got a 5.
Yeah, and this isn't just about the current management team. This is kind of management writ large over the history of Chevron's, 30, 40 years. Chevron, I think, has been slightly more reactive to the ups and downs of the market cycles with their capital investment plans compared to, a steady capital allocator like ExxonMobil who invests through the cycles. In the mid 2010s, Chevron was coming off these mega projects that kind of went sideways on costs, the Gorgon and LNG, Wheatstone LNG facilities in Australia, and it made them a little gun shy about investing in new assets that were like big mega projects, offshore, things like that. Management kind of bet the farm on shale growth a lot in the Permian, in Argentina, and in Algeria. But it's, outside of shale, its future prospects of, offshore and some of the other things, its pipeline of future projects is a little weak compared to the others in the space because of this very reason. Maybe it's in arbitration for an acquisition of an oil and gas company called Hess. It's basically in court with Exxon about the assets in particular. Maybe that acquisition changes it because it would give it significant exposure to a major offshore oil field in Guyana, which has been very productive for ExxonMobil. But so far, I can't say I'm too impressed with what it has in the backlog.
Yeah, I went a 6, echo a lot of the things that Tyler said. When I look at the CEO, Mike Wirth, nothing that really stands out to me as super special that he's done in his tenure. But listen, this guy's a Chevron lifer, started with the company in 1982 as a design engineer. I'll give him 1 extra point above average just for that history with the company.
Well, given that Tyler's digging them for 30 or 40 years of management, maybe being a lifer isn't exactly what he'd love. Let's move on to financials. A 10 is a fortress. A 1 is yikes. These scores are higher. Nick's at a 7. Tyler, you're at an 8.
Yeah. I look, its balance sheet right now looks stupendous. The only time its balance sheet has ever looked better in the last 40 years was like basically from 2008 to 2012, where we were like frequently above $100 a barrel and closer to like 120 many times. If it wanted, it has the capacity to grow the business either via acquisition or development. It wants to, like I said, with the Hess acquisition, but that thing's been held up in arbitration for a long time. But, balance sheet looks great. Cash flow statement's fine. Income statement looks good at present.
Yeah, I'll just put some numbers on what kind of Tyler outlined. I rated the strength of financials a 7, did $15 billion in free cash flow last year against $18 billion in net debt. A couple years ago when oil prices were more favorable, flirting with that $100 a barrel range, Tyler was talking about the company did almost $38 billion in free cash flow. You go back to 2020 when it was about as bad as it possibly could get, and this is a company that still was able to generate free cash flow, and it did maintain its dividend, although it had to use debt to do that. This is a business that is robust, can weather the ups and the downs of the cycle, and that's why I rated it a 7.
It's pretty strong when you can wipe out your debt basically with 1 year of free cash flow. Now, I know it's cyclical, but as you said, it's usually pretty good. Nick, let's move on to valuation. How well will Chevron stock do over the next 5 years? How safe is it? 10's a sure thing. 1's a lottery ticket.
Yeah, so I went 5 to 10%. I think there's upside if oil or gas prices move in their direction, if that Hess deal is able to close, maybe that sort of thing. Maybe gas is more likely to help them given with what's going on with electricity demand. I think the 4.4% dividend is safe, and I think the company can grow modestly over the next 5 years. That gets you that 5 to 10% return range. I gave it just a 2 on the safety score, though, because at the end of the day, really all depends on what happens with commodity prices. If there's an oil price war or another pandemic or, God forbid, a big offshore accident anywhere in Chevron's portfolio, any of those variables could lead the returns to go sideways pretty quickly.
All right. So I did 10 to 15 with a safety score of 3. So my safety score is very reflective of what Nick said. And the only reason I went with 10 to 15 instead of 5 to 10 is I'm just kind of, we'll call it the Gordon dividend growth model, right? So we have a current yield of 4.4%. And historically, over the past 10, 15 years or so, it's grown its dividend about 7% annually. So even over the last 5 years, it's been 7%. So that with no valuation change should, get us like annualized returns somewhere around 11% growth, assuming that the stock price goes at the same rate as its dividend growth. So 11, that falls in that 10 to 15% range. The low safety score is the same thing. Commodity prices can basically go anywhere in the next 5 years. Beyond that, the business looks a little bit more robust. But, when we're talking about commodity markets and commodity cycles, it's just a roll of the dice.
Let's move on to top it, everyone's favorite. Nick, is there a company in Chevron space that you like better?
Yeah, Anand, I like Canadian Natural Resources, ticker is CNQ. They actually just bought some assets from Chevron in December. In my opinion, Canadian Natural Resources is one of the best exploration and production companies in the world, with among the largest and longest live reserves of those producers, and also among the lowest break-even costs. Management has shown the ability to allocate capital throughout the cycle. I've increased the dividend for over 20 straight years. Today, it's got a 4.9% dividend compared to Chevron's 4.4%. I also think if you look at their current capital allocation policy, should be able to buy back another 2% of shares in 2025. I think that's going to go up as they continue to delever from that Chevron acquisition. Although Chevron is more diversified both globally and operationally as an integrated producer, I like the assets that Canadian Natural Resources owns, and for that reason, I like it better as an energy exposed company.
I'll give you a twofer, and I'll go with Equinor, ticker EQNR, and Total Energies, ticker TTE. I think they're both integrated oil and gas companies. I think they're better operators. Their cash generation has been more prolific lately, with some strategic assets in other places that are higher cash generators than what Chevron has. They're trading at better valuations, and both of these companies in particular have the rare knack among the integrated oil and gas companies to invest in energy outside of fossil fuels and generate sufficient returns. That has been a thorn in integrated oil and gas's side for a long time, and these are like the two companies who seem to have cracked the code.
I know you've been on Total for years and years, Tyler. Thank you to both Tyler and to Nick. They're giving Chevron a low overall score of 5.8 out of 10, up a little under the 6.5 Nick and Jason Hall gave it a year ago. Safety and management kind of drag the score down. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Enbridge. Till then, Fool on.
Man.
He's in baby haze. He can't remember anything from last week. I bet he doesn't even know what breakfast was this morning.
That's right. There was no breakfast.